Hi, everybody. Welcome to the Samson Properties Real Estate Investment Club. This is our meetup for February 2021. And today I'm excited to introduce you to John or Jack Kiley, CPA, CISP. He is a certified public accountant and certified IRA services professional. He is a managing partner in Mid-Atlantic IRA, LLC, and John Kiley, CPA, LLC. Jack has extensive knowledge in developing tax, retirement, financial planning strategies for high net worth individuals and closely held businesses. Jack brings to the table over 35 years of experience in a public accounting forum. He feels strongly about his clients having the ability to self-direct their retirement, and Jack's reputation for speaking in plain English regarding complex concepts gets him invited to speak nationally to groups about these topics, and especially self-direction. His specialty knowledge makes him the expert to turn to, particularly when a complex scenario is needed for the purchase of real estate, mortgages, leases, and other cash flows that the IRS allows in an individual retirement. So Jack, thank you very much for being with us today. We're really happy to have you as part of our group. And you and I chatted a little earlier. So as you're going through your presentation, if folks have questions, they can certainly just either raise their hand, type them in the chat, or just let me know. We'll be happy to answer those as we go along.
All right, fantastic. I appreciate that intro, and hopefully I live up to it. I am going to share my screen, so hopefully I can do this effectively. As I said before, I am not the most proficient technology, so hopefully you see my title screen there. And
we do.
All right, fantastic. Let me see if I can. All right, now I can see it, so that's always a good thing. So again, this presentation, I'm going to talk a little bit about self-directed IRAs for the next 45-ish minutes or so. If you have questions, go ahead and throw them in the chat. I'll break periodically to ask for questions, but I do like to answer them on the fly. Although I'll apologize if I don't see them in the chat because I'm busy doing the presentation. So a little bit about me, as was mentioned, I'm a CPA. I'm licensed in Maryland. I'm a principal of Mid-Atlantic IRA, which is a provider of self-directed retirement accounts, which we will I'll delve into a little bit. I'm an entrepreneur. I own other businesses. I own real estate. I own a pool. I have a pool of notes. So I'm a bit eclectic, to say the least. A little bit about Mid-Atlantic. We're an administrator of self-directed retirement account solutions, offering a full range of options while providing superior service and educational opportunities. And we'll talk a little bit more about those at the end. On the screen there, you can see some of the account options, which I will talk a little bit about through the presentation. And on the right side of the screen are some of the holdings of alternative investments that our clients hold. And just by way of reference, probably about 70%, give or take, of what our clients invest in is real estate in some fashion, or lending, and many times lending and real estate kind of go hand in hand. So this is my obligatory disclaimer, which I am obligated to read. So Mid-Atlantic does not review the merits or legitimacy of any investments. We do not endorse or recommend any company's products, services, or investments. And we do not provide legal, financial, or investment advice. If our services were recommended by a third party, such persons or entities are not affiliated with us in any way, and we are not a fiduciary as defined in the Internal Revenue Code, Department of Labor, ERISA, or any other applicable federal, state, or local laws. All information provided here is strictly for educational purposes, and all parties are encouraged to consult their professional advisors prior to making any investment decisions. And that goes with tax decisions as well. So my objective today, I want to spend the first 10-ish minutes to try to get you and challenge you maybe to think a little bit differently about retirement and retirement plans. Um, so first, I want to define what retirement means, especially to people who are working in the real estate industry or investors. And real estate professionals are kind of a special breed in that you have odd work hours. It's nights, weekends, holidays. The job becomes more a part of your being than somebody who has what I would call a day job, a 9 to 5 job. And this is true of business owners or entrepreneurs as well. I mean, we just don't walk away from things at 5 o'clock. Uh, because you're self-employed and you like what you do. The dirty little secret is that you're not going to retire. You may not work as hard as you do now, but the idea that when an investment opportunity presents itself, namely real estate, in the case of real estate investors and professionals, that you're going to say, oh, no, I can't do that because I'm 65 years old or older. I mean, that's just not reasonable. And I can tell you in my CPA practice, my clientele tends to be real estate investors and entrepreneurs. And over the past 35 years, I can probably count on one hand the number of people that actually retired. And by that, I mean they fished, gardened, read, or do whatever their hobby is all day. I just, quite frankly, I just don't think it's human nature. It's just not in our DNA. And for most people, their retirement account is their second biggest asset, the biggest being your primary residence. And these funds, of which we'll talk about in a minute, do have special tax benefits. And so it makes sense to pay a little bit of attention to this pool of funds. And it amazes me, quite frankly, how most people really don't. They think about it during tax time because if they're putting money in a plan or in their IRA, there's tax deduction potential there. And they may have their year-end statement from their provider, but that's usually the extent of it. And for most people, this is where, as I said before, this is where most of their investable funds is, because it's their second biggest asset. But this is not necessarily true of people in real estate. So most of us are led to believe that we should, especially if you watch the commercials, that you should accumulate funds in a retirement account, put it in the stock market, watch it go up and down in value, and then at some anointed point in the future, when you retire, start to pull those funds out, and that's what you're going to live on for the rest of your lives. And I can tell you from experience, that's not what happens. And as I mentioned before, particularly not people in real estate. My personal opinion of why this is because people in real estate generally are hands-on people. We like to know what we're investing in. I think, quite frankly, I think we like tangible things that you can hold on to, things that you can see. And you like to understand your investments. And the reality is most of us really have this nagging feeling about putting money in the stock market and just letting it ride. And because of this, real estate people in particular shy away from putting money in retirement plans because they would rather invest in real estate and end up creating what I would call a taxable retirement portfolio. So given this, I really want to challenge you to think of retirement plans a little differently. And I want you to think of your retirement plan as a very variable annuity. And by this, what I mean is that I want you to think of this, excuse me, as an account where the earnings are either tax deferred or tax free. And quite frankly, that's the contract that you make with a retirement plan. And you have the ability to invest in the types of assets that you understand better or can manage maybe more effectively than, say, marketable securities. And this is where self-direction is the perfect tool for this. So in a perfect world, what you would do is you would make all of your real estate investments in a tax deferred environment or tax free if it was Roth, and pay tax only on what you pull out. So, in other words, you would be paying tax on consumption, what you spend, as opposed to production, which is everything you earn. And this is the part of the power of self-direction. And I want to contrast this a little bit and just give you an example. So if you buy a piece of real estate, and let's just say that you buy a piece of real estate for $100,000, and you hold on to it for a period of time, and then you sell it for 150, and forget closing costs and all the rest of that. If you do that in a taxable environment, you pay tax on $50,000. And granted, if you've held it longer than a year, it might be capital gains, but you pay tax on production. In other words, everything you earn. If you spend $10,000, you still pay tax on the 50, right? If you do that in a retirement plan, you don't pay tax on anything if you don't pull anything out, or if you need $10,000 and you pull $10,000 out, you pay tax just on that amount of money. So, that is the power of self-direction. So let's just talk a little bit about what is a self-directed. I have IRA here, but this could be any type of retirement account. So this could be and we'll look at a few of these a little later, SEPs, simples, 401ks as well. So the first gate, if you will, in self-direction is that the custodian allows a wider variety of investment options, and what you're looking for in self-directed, and self-direction is just a marketing term, but really what you're looking for is in the minutia of the document, the agreement, the IRA agreement, is what are the permissible investments that the custodian will allow. And these are investments that the beneficial owner, which is you, if it's your account, fully directs. So you select the investment options. You're in control of the management of the assets, and the vendors utilized for effecting those transactions within the account. You're in control of all of those items. And there may be some constraints by law or by the account document. And I kind of referred to this a little earlier. The account document is referred to as a 5305. And in there, you might see some limitations of the investment options. A lot of times I will hear this: my investor says that I can self-direct, but I can't buy real estate. And really what that advisor is saying is that you can sell anything, you can buy anything that they sell. The thing that you need to keep in mind here is that most providers of IRAs and retirement plans are not in the IRA or retirement plan business. They are in some other core business. So Fidelity, Vanguard, Merrill Lynch are in the business of buying and selling securities. If you invest in at a bank, it's CDs, because their core business is lending money. So they use the IRA or the retirement plan as a conduit to bring funds into their institution to do whatever their core business is. And in doing so, they limit your investment options. Okay. So let's talk about what is permissible in a self-directed retirement account. So typically, or what the law says actually, is what is not permissible. And it's a very short list of 2 items. And to that list, I always add 2 additional items. So the investments that are not permitted by IRS, the first one's is collectibles, and fine wines, works of art, anything that has that collectible nature to it. The second is life insurance. The 2 items that I put on the list that are not mentioned in the regs. The first is that in the IRA world, the IRA cannot make a loan to a disqualified person, and we'll talk about what that is in a second, or the beneficial owner. And the reason I always include this is many of you have 401k plans which do allow participant loans. In the IRA world, that's not permissible, and we just refer to that as a distribution. The last item here is a little esoteric, and that's an investment in S corporation stocks. Some of you may be organized as S corporations, and what that essentially, to be an S corporation, you have to have a limited number of owners, first of all, which is 125, which is a low bar. Most corporations, quite frankly, in the country have less than that. And then second of all, they all must be individuals. And by definition, an IRA or a retirement plan is a trust. So if it invested in an S corporation stock, then that would violate the S election, and the S corporation would revert to C corporation status. And all the other investors, quite frankly, would be probably a little unhappy. The next part of the do's and don'ts, if you will, of retirement plans talks about who the IRA or who the retirement plan can transact business with. So transact business is to buy, sell, exchange, lend or lease, provide goods, services, or facilities, or provide a benefit, in other words, a guarantee, to or from the account. And these things work in both directions between disqualified persons and the account. So disqualified persons are, again, people or entities that the IRA cannot do business with. And these are people or groups that are identified in the law. So anybody not mentioned here is fair game, similar to the investment options. So the first group is family members. So if you sort of visualize this and you put a dot out there in space and you draw a vertical line through that dot, anybody that's on the vertical line is disqualifying. Okay, so you, as the beneficial owner, are disqualified. Your ascendants, descendants, spouses, and entities they control. So again, anybody on that vertical line. So if your mother owned a piece of real estate, your IRA would not be able to buy that real estate from your mother. If your father's LLC, if your father had an LLC that he wholly owned, or he owned more than 50% of, then that LLC would not be able to buy an asset out of your account. Okay. And one of the things that the IRS is concerned of here is things like generation skipping in estates, and also, shifting assets between taxable and tax deferred environments at maybe less than fair value. So particularly with illiquid assets like real estate. The second group are people that work for the account. So for instance, if your account is with Mid-Atlantic, I would not be able to buy an asset out of your account. Okay. Actually, I'm going to backtrack to family members for a second. Remember what I said about that vertical line. One group of family members not included in that disqualified group are siblings. So brothers and sisters, aunts, uncles, cousins, that sort of thing. So it's only your direct lineage. So I guess the IRS feels that sibling rivalry is alive and well. Sorry, I missed that earlier. And then the last group is always the fuzzy group, and that is referred to as certain other business relationships. And this is kind of on a case-by-case basis. And I will let me give you an example to kind of contrast this. So if someone, let's say Sam and I are partners in a business, and between the two of us, we control the entity, and we make all the decisions for the entity, then he and I are disqualified with respect to each other, because we already have that financial connection. But if Sam and I are maybe 10% owners in a real estate investment, we're just the money in the deal, so to speak, then we are not disqualified with respect to each other. We just happen to be invested in the same thing. And quite frankly, probably about 20-25% of the calls that come into our office are on these sorts of scenarios and these kinds of things. So if your account is with us, we encourage you to call and discuss these kinds of things. And here is a matrix of these various relationships. And if you want this, you can certainly email us, and let me, we'll be happy to get this out to you. So at this point, if there are any questions, I'm more than happy to take them on this, on these, on this. We have any questions? I'm looking from straight. Oh, here we are. I lost my.
So basically what you're saying, Jack, is that if I want to buy an investment property with my IRA, I cannot rent it to my daughter or to anybody in that lineage. She cannot have, it has to be an arm's length transaction from.
Yes, that's exactly right. So there's no, some of the questions that that we get a lot are, can I rent it to a family member, for instance? And the answer to that is no, even at fair market value. And the reason for that, if you kind of think about this, if I rent my property to Sam Smith, and Sam has damages my property, what am I going to do? If it's beyond the security deposit, I do have the opportunity to go after him according to the lease. If I rent it to my son, and my son has a raging frat party in the property, and they punch a bunch of holes in the wall, what am I going to do? I'm going to fix the holes is basically what I'm going to do. So I'm not going to go after a family member maybe in the same way that I would somebody else. And that's, those are the sorts of things that IRS is looking for. There's a benefit to the account, for instance, by allowing my son to utilize the assets in the account. That's problematic. So in the IRA world, or in the retirement plan world, anytime that you or any of these people, these disqualified persons, are getting a current benefit of either the assets or the money in the account. So in our example, my son is renting. He's got constructive receipt of the asset. That's a distribution. So that's where the problem lies. Let me just see if there's anything else in here in the chat. I don't see anything. So anyway, that's that's the nuance there. That's what they're looking at. And again, from the IRS's perspective, there are what they're really concerned about is being able to shift assets from taxable environments to tax deferred environments, or moving assets from generation to generation. So if my mother, for instance, was not disqualified, and she owned, she had a piece of valuable real estate, maybe she sells it to my IRA for, at some discounted price. I mean, in real estate, you and I can look at the same piece of property, and you might think it's worth, $200,000. And I might think, especially if it's mine, I might think it's worth $250,000. So there's, you have competing interests, if you will, and you meet in the middle, right? Willing buyer, willing seller, all those sorts of things. And by ferreting out these disqualified persons, IRS is really trying to get to that willing buyer, willing seller, and that relationship. So again, any other questions on this? We can certainly go over them. And again,
so it's interesting that you could rent to your sister or brother or whatever, and if they punched a hole in the wall, then it's a different, interesting.
Right. And it's kind of, it's one of those just oddball things that you see in tax law from time to time. And the urban legend is that the way these things are done in tax, first of all, there's no new ideas. Any of us who have been around a while, we see a bunch of recycled things. Tax rates go up, tax rates go down, capital gains periods go, from a year to 6 months to 18 months. Yeah, I mean, it's the pendulum swings, so to speak. And when IRAs came into being back in the mid 70s, a lot of these rules and regulations and whatnot were born or taken out of the nonprofit area. And whoever developed the DQ, disqualified persons rules, actually went into great depth in all of this, and for whatever reason politely ignored siblings. And the urban legend is that that person was asked in some congressional hearing, why that was. So a congressman actually asked a good question. So that was, kind of interesting in and of itself. And the answer that the guy gave was, well, I don't have any siblings, so I never thought about it. And you know, uh, it stayed that way ever since. So whether that's true or not, I don't know, but it's a good story. So, all right. So if we don't have anything else on this, I will.
We do have one in
Yep.
here, but it may be something you haven't gotten to yet. So the question is, if we're buying real estate from our IRA, it means borrowing from our IRA. What implications do we have with the IRA? Do we need to return part of the funds at the end of the life cycle of the real estate investment? So I think you're going to get into that next, I'm presuming.
Yeah, I think so. And really what I want you to, and this is one of the sort of blocking points, if you will, with self-direction or people thinking about self-direction. Holding real estate in a retirement plan is no different from holding a stock or a bond. So real estate, if you buy 125 Main Street, for instance, 125 Main Street is just a holding in the account. So the IRA is actually purchasing the asset, not you. So it's not, the construct isn't that you're taking money out and you're investing in an asset and then somehow that, all of that occurs outside the IRA. All of this is occurring within the IRA. So holding 125 Main Street is no different from holding Google stock, for instance. Okay, it's just a holding in the account. So the money goes out of the account to buy 125 Main Street. When you look at your account statement, it's going to say 125 Main Street. And when 125 Main Street sells, the money comes back in the account. So at the end, an IRA, I'll say this at this point, and then we'll circle back to this at the end if we have time. An IRA is a trust, so it can borrow money. And that's one of the advanced strategies. So, and we can quickly go over that at the end. I'll tease that a little bit and hit that at the end. But I think that's the essence of what that question was. Okay. So with that, I'll sally forth a little bit here. So these are some of your retirement plan options, and in the first column here is Roth and traditional IRAs, and this is available to pretty much anybody. The SEPs, simples, and the 401k options are for people who are business owners. So people in real estate are generally self-employed. So these are options that are available to you. SEP, simple, and solo 401k would be the best, assuming that you do not have employees or people that work for you other than you. And it might be you and a spouse. In real estate, a lot of times there are husband and wife teams where you might have two people, and they don't have to be related. But if you have an entity that is owners only, a solo 401k plan may be of value to you. And the reason that people look at these is that, again, if you can make the same sorts of investments in a tax deferred, or if it's Roth, a tax-free environment, that you are making in a taxable environment, it makes sense to effectively move money, if you will, from your right pocket to your left pocket and do that in a tax deferred environment. So the SEP simple 401ks are just um, larger contribution limits, and I can just kind of go through this quickly by way of an example. If you have, let's say that you're in your business, and this wouldn't be a large business by any means, but let's just say that your net earnings are $50,000. If you're looking at IRAs, it's either $6,000 or $7,000, depending on your age. If you're looking at a simplified employer plan, which is the easiest plan to set up, you can set it up anytime. You can fund it all the way up to the point that you file your tax return. It's 20% of your net earnings. So you could put in 20% of the 50, which is $10,000. Get a tax deduction for the 10. Go do real estate or alternative investments, lending, whatever it is that you want there. But your net taxable income is effectively 50 less 10. If you're looking at that simple IRA, there is an element, what's called a deferral. So it's kind of like a 401k plan. And if you're an LLC or you're self-employed, all of your earnings are deemed to be available for making that deferral. So you can defer up to 13.5, and then there's another 2 or 3% that you can put in on top of that of your net earnings. So again, if you're at that 50,000, you could defer the first 13.5. If you're over 50, there's another $3,500 just for the pleasure of being over 50. So that gets you to 16. And then 2 or 3% is another $1,000 or $1,500. So you can, again, now you're at 17-ish $1,000 of deductibility, and your net is reduced even farther to what, $28,000. Okay. The solo 401k plan allows you to defer either 19.5, or if you're over 50, another 6,000. So that's 25.5 and 20% of the net, which is another 10,000. So, that's kind of the nirvana, if you will. You got 25.5 plus another 10 takes you to 35.5. So if your taxable income was 50 and you could deduct 35.5, that's a pretty good deal. And again, what you're talking about here is moving money from a taxable environment to that tax deferred environment, and still having the ability to make the same sorts of investments that you want to make. Okay. Meaning real estate, or again, a lot of people in real estate are interested in lending money as well. So those are attractive options. And the other thing I would say to you, for those of you who may be rehab property in particular, self-directed retirement accounts are a great source of capital. So if you know somebody, for instance, who has money sitting in a retirement plan, and maybe they are a fixed income kind of guy in today's environment, here as we sit in the winter of 2021, interest rates are in the toilet. So if you could offer them, instead of the 1% that they're earning on fixed income now, if you could offer them 7, 8, 9, 10%, that borrowing is 8, 9, 10,000% better the return on investment than they're getting right now in their retirement account. And that money too tends to be very sticky, meaning that once, assuming you're good at what you do, when your rehab is done and you sell and the person gets paid back, that your biggest problem is generally finding the next deal, because they like what you do, and they like the security in the property and those sorts of things. So it tends to be a pretty good source of capital for rehabbers or people in real estate. So think of these self-directed accounts in both directions, not only the self-serving part, what's good for you, and we talked about contributions and all those good things, and the accumulation of assets, but also as a source of capital. Quite frankly, many hard money lenders get their funds from self-directed retirement accounts. So,
but not their own, right? They have to.
No, exactly, not their own. So, I mean, there's some big hard money lenders out there, which basically they borrow money from self-directed accounts, maybe at 6, 7, 8%, and I would kind of put that in a boat, and I call that private lending. Okay. And then they turn around and obviously lend it out at 12, 13, 15% plus points. So, and they're making money on the spread, obviously. But that's, kind of an interesting little fact, I guess. So the process for an investment, and this is, I think, a little bit answers partially, at least, the question that was asked earlier, is this. So first thing you need to do is establish an account, and that's basically paperwork. There's an application, it's name, rank, and serial number. And then funding your account happens in a couple of different ways. You could make direct contributions. You could, and this is typically what happens, is funds are rolled over from old 401k plans, so not employers that you're working for now. These would be old employers, or they're transferred from other IRAs. And you'll hear these terms used interchangeably, and those terms being transfer and rollover, but they do mean very different things. So a transfer is when money moves from IRA to IRA. And when that occurs, you use the transfer paperwork of the successor custodian. So if you're opening an account with us, you would complete our transfer form. All that comes back to us. We countersign it, and we send it on to your current custodian, and they will act on those instructions. If it's an old 401k plan, you have to talk to the administrator of that plan, because every plan has different rules and regulations, and they may have things that they've got to satisfy. So you have to complete their paperwork, and then they will push, if you will, the money over to your retirement account. So that process, if your money is with Vanguard or Fidelity, those types of organizations, it's usually maybe a week to 10 days. If you're with a traditional brokerage firm, it's probably on the order of 10 days to 2 weeks. If you're with an insurance company or an annuity, it could take a month. So you want to keep those timelines in mind. Okay. Typically, when somebody opens an account with us, they already have an investment in mind. So we're sort of working on two different tracks here. We're working on the opening of the account, and also the investment, funding the investment, and trying to bring those things together at the same time. When you identify an asset, you want to contact, at least with us, you want to contact the account rep, tell them what you're looking to do. And there might be a conversation there about disqualified persons and all that kind of stuff. And again, we want to kind of do that early in the looking at the investment phase, because if it's something that you can't do, then it's good to know up front. And with a lot of other providers, they don't want to see any of your paperwork until you have it all together. And the challenge with that is a lot of times you're halfway down the pipe before you realize that you can't do something. Or if you're new to real estate, which I don't think this is the case for anybody on this call, but new people to real estate don't even know if they have everything all together or not. So it's kind of hard to determine that. But anyway, you contact us early. We'll send you what we call the bi-direction letter, which is just an authorization to buy whatever it is that you're looking to invest in. And we'll actually contact the settlement company and tell them that it's an IRA that's buying, or a retirement plan that's purchasing the asset, not the individual. Sometimes they need some things from us. We need some things from them, but you and us are sort of walking down the path together, so to speak. And our job is to make sure that that everything, all the I's are dotted and T's are crossed in that. The other item I would mention here is when you make an offer on the property, you want to make the offer in the name of the retirement account, and then or your business, or or you personally. And the reason that you want to do that is that that allows you, first of all, because you're a party to the contract initially, to deal with all the machinations of the negotiation. So, technically, if they don't accept your offer as is, that's a counter offer, and there's initialing and signatures and more paperwork and yada, yada, yada. And you can do all that without having to run to us. You want to make sure that it's or, because and we run into this all the time, if you make an offer that's in your name only, then technically you're trying to assign it to your retirement account. And an assignment is perceived to be for value, meaning that there's an exchange of money or something. So if you think of it this way, if I have control of a contract and I want to assign it, for instance, to Cynthia, although Cynthia's a nice person, I'm going to want to be paid something for that service, right? Okay. And the IRS views it that way as well. And the minute that, keep in mind, as I said before, you and your retirement account are disqualified with respect to each other. So the minute that there's an assignment, then that's a problem. And usually one of the questions that comes up all the time is that, well, how come I can assign something from me to an entity that I own, and I don't have to, there's no exchange of funds or those sorts of things, and that's not a problem. And the reason for that is that you are the owner of both of those entities. So you're just assigning something from you to an entity that you control. So you're just assigning something from you to yourself, if you will. Okay. And again, you have to keep in mind your IRA is a separate person or a separate entity from you. So there's a transaction there. So you want to make sure you make your offer in the name of the IRA and or you personally, or you're an entity that that you have. And then once you get closer to settlement, you can, obviously you'll fall off the contract. So, again, we contact the settlement company as you move towards settlement. You might have inspections, those sorts of things, and you are in control of all that. You can hire whoever you want to inspect the property. That has to be paid out of the IRA. Whatever comes out of that, obviously, if there's credits to the or a reduction in price or any of those things, then all of that is obviously sorted out. As we get closer to settlement, we'll get a clean set of documents, and you'll probably have received them as well. But what we're going to do is we're going to send them to you for your approval, because we want to make sure it's exactly the deal that you think it is. And about once a quarter, there's something in the documents that is not what the client thought it was. And it could be, we've had situations where, maybe a property was, the first set of documents said that the purchase price was, $1 million instead of $100,000. There's been transpositions. I mean, that kind of thing happens to all of us. But we want to make sure that you've got a clean set of documents. Or many times what happens too is that in the inspection process, maybe there was a credit given for a repair or something that needs to be done. And we want to make sure all those things are encompassed on the settlement sheet. Okay, so we have a read and approve process. Once you approve it, will send money out of your account to the settlement, and title passes to your IRA. So if you actually look in the land records, the titling of the asset is going to read something along the lines of Mid-Atlantic IRA FBO, which is for the benefit of, and then your name and the type of account it is. And if you don't want your name on it, we will use account numbers. So it might say FBO account number 12345, IRA. And that is a standard naming convention for retirement plans. So if you look at your statement, it's the name of the custodian and then words to the effect of for the benefit of, participant, custodian for, and then your name and the type of account. Okay. So any income attendant to the asset needs to come back into the account. Any expenses need to be paid out of the account. So if you are, rents obviously go back into the account. Real estate taxes are paid out of the account. HOA dues, insurance, all of those sorts of things. Okay. If you have management agreements, those need to be in the name of the IRA. Leases, the lessor is the IRA, not you. You want to make sure that checks are made out to the IRA, not to you. And those are the sorts of things that you talk to your account rep about. So that's the process. You want to keep the time frames of the movement of money if you don't have good funds in your account, from the successor to us or to whoever you're going to use. Some of the advantages and disadvantages of self-direction. The big advantages are that you have choice of investments, vendors, advisors. Nobody is telling you where to purchase or what to purchase. I have a client, for instance, who owns 3 properties on one street, and she does not, for whatever reason, she doesn't want to invest in property anywhere else. It's just that one street, and quite frankly, they're within about a 3-block radius of each other, and her reason for that is that she likes to be able to look out her window and see them. But that's her thing. Okay. So you can be very specific. You get to leverage your knowledge. So if you like single family homes, you can invest in single family houses. If you like raw land, you can invest in raw land. If you like a certain area, which is not unusual. I mean, most of us in real estate, we have a niche. We have a certain type of property we like, or a certain area, and you can utilize that. You can invest on a micro level. I talked about that. The lady who has just one area, one street. If you want to buy 125 Main Street, assume that it's not owned by a disqualified person. You can do just that. Diversification. You're investing in things. Certainly there's a place for stocks and bonds, but not all of your eggs are in the stock and bond basket. And so diversification. Some disadvantages. For some people, this seems too flexible. And for some people, quite frankly, a lot of latitude can lead to issues. So, if you are a salesperson, the back of the napkin, art of the deal, free thinking, it's you can do it, but it's going to be, it's going to be a little bit of a challenge. Not terrible, but just recognize that there are rules. But if you're in a regulated business, if you've been in the military, or you have a good appreciation for rules, this really shouldn't be an issue. And, at least with us, your account rep in our office is always a good resource. So anything that you think is not is problematic, have the conversation. And then custodians and administrators are not advice givers. Okay, so in the self-directed world, as I mentioned in the disclaimer, you're not going to get an opinion on, is it a good asset or a bad asset? Is it a good investment or a bad investment? Is it a good area or a bad area? That is not our function. And some people misconceive that. So just keep that in mind. And it's not just us, it's all custodians and administrators. We are not fiduciaries. So, but you can look to your team and your network, and that's where you can get your advice and those sorts of things. Okay. So ways to, ways, we can take some questions and ways to engage us. I'll leave my, my email up there, phone number, that sort of thing. And let's see if we've got any other questions at this point.
If people want to take off their microphone and just ask, that's great.
Yep, let's do that. That'd be good.
Okay. I have a whole list of them, but I don't want to go before anybody else who maybe has some. Anybody else have questions they want to ask? I'll hold mine to the end. Okay.
All right, fire away.
All right. Can I use my self-directed funds to purchase in a foreign country?
Yes. Okay. So we have clients actually that own assets all over the world. There are the only places that you cannot invest, quite frankly, any money, if you're a U.S. citizen, are on countries that are on the State Department's hit list. So it is, such places as Iran, China, Yemen, in this hemisphere, Cuba and Venezuela. But we have clients that own property throughout the Caribbean. Brazil, for some reason, has been very hot lately. We've had a number of inquiries there. So the answer to that is yes, virtually anywhere. Okay.
That's good to know. As a global realtor, that makes me happy. So what if I want to, I'm not fully retired, but I'm thinking down the road that I want to take my self-directed IRA and invest in a property on the beach in the US. I rent it out, but eventually I want to live there. How do I get it out of how do I roll it back out so that I'm not breaking any of the rules of the disqualification?
Yep, that's a good question, and one that comes up periodically. So when you, at some point, if you did that, what would happen is at the point that you wanted to use the property, you would actually take a distribution of the property itself. Okay, so at that point, we'd get an appraisal on the property, and whatever the fair market value of the property is would be the distributable amount to you. So there are some strategies that people will look at and to maybe minimize the tax hit, and some of those things might be that they distribute out over a period of years a percentage of the property. So it kind of looks like a tenants in common. So maybe the first year you distribute a 20% undivided interest, the second year another 20, and and kind of stratify that tax over time. Having said that, you're not going to be able to use the property until it's fully distributed out to you, because from a practical standpoint, in my example, which 20% is yours and which 20% is or which 80% is the IRAs. And I think with tenants in common property, it is the owners are deemed to own whatever their percentage of ownership is in each component of the property. So you can't really stratify that. So that might be one option. The other option might be to actually convert. So if you're looking, let's be fanciful here. Let's say, well, here, I'll give you an example of one that somebody did a number of years ago. They bought a lot on the coast in Carolina, and the lot was $100,000. So instead of doing that with traditional IRA money, then they wanted to keep the lot and build on it later. Okay, so instead of doing that with traditional IRA money, what they did is they converted to Roth. So they paid tax on $100,000 right then and there. And then I think it was 6 or 8 years later, they distributed it out to them personally. So in Roth, the distributions are tax-free. You have to hold it for 5 years. There's a 5-year seasoning with Roths. But what they did is they paid tax on $100,000. So it was roughly maybe $25,000 of tax. And they converted the money to Roth. They bought the piece of land in the Roth. And when the fair market value appraisal was done 6-7, actually, I think it was 8 years later, the value of that lot was about 225 or 250, somewhere in that range. So in that case, there was about $125,000, $150,000 permanent timing difference. So, those are some of the planning techniques, if you will, that you can get involved in, or you can start to look at. Or, quite frankly, if you didn't have all the money up front to convert on $100,000, you could buy that asset in the traditional IRA and then convert a piece of that to Roth over a period of years to lock in that taxable amount, if you will.
Okay, that's good to know. And so the more you talk, the more questions I have. But remember, this is our investment club, so I'm trying to figure, in today's world, we have to think outside the box, and we have a lot of people who are looking at retiring or looking at, there's so many different ways that you can use this. So for instance, if you're looking at a property, which you already mentioned, purchasing, and we talk about hard money or other people's money, that's our favorite thing, OPM, other people's money. And that's really where this type of thing comes in, because you may have family members, friends, whoever. So like, for instance, with Anthony and I, if we're both investors, I might go to Anthony and say, hey, I want to use, will you invest in this? And then I'll invest in yours, and then we can each make money back and forth for each other. Or to your point, maybe you need rehab funds, right? And so you can borrow portions from each other, or you can, Anthony and I may be able to team up. Maybe I don't have enough money in my self-directed IRA, and he and I go into a partner on some other piece of property that we know, we've done our research, that once we flip this, it's gonna, we're both gonna make a lot of money on it, put it back into our IRAs, correct?
Right. Well, so you do have to be mindful of the relationship, because you and Anthony may be disqualified with respect to each other. Okay. If you're merely investors in something, that may not be the case. So, and the other thing is you can't, there can't be a quid pro quo. So you can't say, well, if you lend me, one of the questions I get all the time is, all right, if Sam lends me $50,000 out of his IRA and I lend him $50,000 out of my IRA, we can go do blah, 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 blah. And that's not necessarily true. Okay. Because if there's that quid pro quo, then the IRS is going to look through the essence of that transaction and say, well, you took a distribution out of yours for 50 and he took a distribution out of his for 50. And that just gave you a pool of money to use. That said, in your scenario, and there are, when we talk about this in a lot of our webinars and those sorts of things, you can, with these disqualified persons, you can partner, and I'm kind of using that term a little loosely, together, because in a partnering arrangement, one party is not buying something from the other party, right? You're combining funds and you're buying something together. So think of it this way. If you're already in the pool, a disqualified person can't jump in the pool. You guys can jump in together, okay? But you can't, if one of you is already in, the other can't come in. So in that construct, maybe you and Anthony you combine funds, okay? So maybe one of you has IRA funds, the other has personal funds, or maybe you both have IRA funds. You form a little entity. The two of you invest in that entity, okay, and your percentage of ownership is going to be driven by money in the deal. So it's not unusual, for instance, in a normal sense, if you and I are investing together, and maybe you're the boots on the ground and you're the one who's going to work on the, deal with all the machinations of the property, and I'm just money, I might put in 80% of the money, but we may split profits 50-50. You see those kinds of things all day long in real estate. When you have disqualified persons, you can't do that. Okay. So if you and Anthony, in your example, are disqualified with respect to each other, your percentage of ownership is going to be driven by money in the deal. So your profits, as you pull profits out, you're going to pull it out based on what that percentage of ownership is. So everything is pro rata. So if it's 60-40, money goes in 60-40, it comes out 60-40. Okay. And again, these are the sorts of things, if you're, the way I always try to get people to think about this is, in tax, there's three buckets. There's taxable money, which is everything that we do, right? Earnings, investments, those sorts of things. There's tax deferred, which is, a lot of what we're talking about here. That's traditional IRAs, 401k plans, annuities would be in that boat, which is an insurance, but an investment product. And then there's tax-free. And there's very few things that are tax-free. It's Roth IRAs and Roth 401k plans. Municipal bond interest is tax-free. And then the other, which, you probably don't care about at a certain point, is life insurance proceeds. But, if you've died, you don't really care about that anymore, right? So the idea is to move money from taxable environments to tax deferred or tax-free, and sort of move from bucket to bucket. So if you're a real estate person and you're earning $50, $75, $100,000, and you can take part of that money and put it in that tax deferred bucket and invest in property or lend or whatever it is that you want to do for higher rates of return, better control of assets, all of those things, then all of those earnings are tax deferred or tax free. And then there are opportunities periodically to jump from tax deferred and tax free. And those are sort of some advanced strategies. But ultimately in real estate, everybody in real estate probably, depending on how active you are, you see, pick a number of deals a year, 25, 50, 100, 200, 500, whatever it is. Okay. There's a certain percentage of those deals which are home runs. They're going to be money makers. They're going to cash flow. That those are the ones that you want to jump at. Those are the deals you do in your retirement account because they're home runs. They're triples. The ones that are a little edgy, there's a little more finesse involved. You do those personally because the reality is, if you lose money, which none of us like to do, but mistakes in real estate can be expensive, right? At least you get the tax, you can take the tax loss. In a retirement plan, you can't, if you lose, you just lose, okay? So, as you're looking at these deals, again, home runs, and in a lot of people, one of the things that they don't necessarily grasp, in a lot of investments, and this is not true of seasoned real estate people, but it is of novices. It's about cash flow, right? If we're talking about investment properties, it's about cash flow. It's not about net income. Okay. So when you're looking at these things, the properties that cash flow, you want to put in your IRA, because typically the cash flowing properties too are more valuable. They appraise higher. If they're commercial property, you're into the cap rates and all those sorts of things is how they're valued. So those are the things that you want in your retirement account, because you can manage your tax position, because you're only going to be taxed on what you pull out of the account, not what it earns. Okay. So the buildup there can be powerful to buy other investments.
Yeah, I watched a friend of mine, he was an attorney, build his wealth through investing the property through his IRA. We have a question about 1031, and then I have a question about self-directed IRAs versus solo 401ks. This person wants to know, can an IRA invest in a 1031 exchange?
So yes, the short answer is yes. And the IRA can invest in any, they can be the purchaser of a property in a 1031 exchange. Usually the question, there's two blocking points that I usually hear for utilizing IRAs to buy real estate. And quite frankly, these don't really come from real estate people. These usually come from stock and bond guys. The first is, well, I don't get the value of depreciation in the plan in the IRA, and I can't, I can always do a 1031 exchange personally. So what's the big deal? And putting my tax hat on here, the big deal is essentially this: when you do a 1031 exchange, you're just kicking the can down the road. At some point, you have your final transaction and you pay tax. And really what you're doing in the 1031 exchange is you are just deferring the gain on the sale into the new property. So when you sell property 2, you're going to pay tax on the gain on property 2 and the gain on property 1. The other thing that a 1031 exchange does is you're constrained possibly by time. So right now, in many markets, there is the inventory of available property is short, meaning that there's more buyers than there are sellers. So maybe I've got to, so in a 1031 exchange, I've got to identify in 45 days and I've got to settle in 180 days. If I identify, or I can't identify because I keep getting outbid, or I keep missing, if you will, then I've got to eat it anyway. All right. So you've got a time frame, and you may be pushed into property that maybe you don't want. Also, investors tend to like, as I said earlier, we have a niche, so for me, I like properties that are, don't have a lot of maintenance. Maybe they're in the 250 to 350 range. And if I've sold an asset at 350 and now I've got to reinvest $350,000, maybe I'm pushed out of my niche. So I'm buying something that maybe I don't necessarily want to buy. In an IRA, I don't have any of those issues, because 1031, the gain's deferred already until I pull money out. So I don't have to worry about reinvesting. I don't have to reinvest everything in new property, which you have to do in the 1031 exchange. So I'm free of a lot of that stuff. With respect to capital gains or depreciation, as I said earlier, first of all, we're talking about cash flow. So I'm not really concerned about depreciation. In a taxable environment, depreciation shelters some of the gain, some of the cash flow from current tax. But ultimately, when I sell the asset, I got to pick it up anyway. All right. So it's a deferral, quite frankly, not a permanent thing. And again, in the IRAs, I'm concerned with cash flow. So the good cash flowing properties, I don't really care about depreciation anyway, because I want cash. I want the return. The other thing, which I didn't say earlier, was, you don't get the benefit of capital gains. And my response to that is, well, if I bought Google stock at $10 a share in my retirement account, and it's now worth $10 million a share, I don't get capital gains treatment there either. So that's a non-starter. So anyway. Oh, I can't hear you.
Yeah. So that's a great answer. So what's the difference? Because we've had other people chat with us about self-directed IRAs, and they are really keen rather on solo 401ks. Can I do the same thing with each of those vehicles?
Yes. So actually 401k. So there are, back on, let me,
Yeah, I know there's a lot of them.
now
That
well,
list.
I'm going to go back to this screen here for a second. Okay. So here's your basic options. Okay. The the first one there, the Roth and traditional IRAs, anybody can have those. Okay. Uh, the other options, so SEPs, simples, and solo 401ks, are options that are only open to businesses. So a business has to sponsor those plans. So if you're an investor, meaning that you just own rental property, from a tax standpoint, ownership of rental property is an investment activity. So that's not a driver, if you will, to have one of these other plans. If you are a real estate professional, or you have a management company or a brokerage, or an agent, then these are open to you. And quite frankly, the solo 401k is absolutely the best option because, first of all, the contribution limits are higher. So the deferral piece that I talked about, which comes out of your pay, is $19,500. And if you're lucky enough to be over 50, you get a $6,000 bump. So you're at $25,500. And then you've got, if you're an S corporation, it's 25% of your W-2 income, or if it's an LLC, it's 20% of your net income that can be put into the plan. So up to roughly 57,000. And again, if you're over 50, it takes you to 63,000. So if you make, let's say for the sake of discussion, that your net income is $1.25, you could defer, I could defer 25,500, which is the 19 plus the 6, and then 20% of the 125,000, which is another 25 grand. So I'm at 50 plus $1,000 of deduction. The other advantage to solo 401k plan is if you're interested in Roth, you can make that deferral contribution, in other words, what's coming out of your pay, on a Roth basis as opposed to a traditional basis. Now, you don't get a tax deduction for it, but the earnings compound tax-free as opposed to tax deferred. And the other big option or advantage is that there's a borrowing provision in the 401k plan, or at least in our plans. Other providers might not have that. But basically, you can borrow personally up to $100,000, or up to $100,000 in the plan. So you have a ready line of credit, if you will, for funding taxable investments. So there are absolutely huge advantages. And if you are, and there's a few other compliance issues that you have to run through with respect to, if your plan is worth more than $250,000, you got to file a tax return for it at 5,500 EZ, which is not, it's not hard, but it's, there's a couple of other little things that you got to do compliance side there. The other big advantage is that there's, and this is really a discussion for another day. There is, in certain instances, there is what's referred to as a UBIT tax, unrelated business income tax, which could be applicable to IRAs, which is not applicable to the solo 401k. So that's the other advantage.
Okay, so I can do, like, if I have $1 million, I can take 500,000 out of my solo 401k and invest in a property, because it's not a personal investment. So I can invest in gold and silver and coffee farms or anything like that out of my solo 401k.
Right. And the issue that you're looking at is, that plan document, be it an IRA plan, a SEP, simple, or a solo 401k. What you're looking at is what what are the investment options? So truly self-directed companies like us, what our documents say is something along the lines of anything permissible by law. Every once in a while, you'll see language in there that talks about assets that are not administratively feasible, which is there's times. So for instance, like right now, marijuana is a hot investment in certain areas. Okay. For IRAs, it's administratively not feasible for many custodians to allow clients to hold those assets because the underlying regulatory powers that be are state regulators. So even though Colorado allows those sorts of investments, New Hampshire doesn't, or Kansas doesn't. So you've got, money can't cross the state lines. And, so you get into some regulatory types of issues, but so that would be something that at least for most providers is not a feasible investment. Okay. So.
How about Bitcoin?
Bitcoin is, can be done. It's a bit of a challenge, but it's doable. And it'll be interesting over the next several years to see how the government handles that. So on your tax return, whether you realize it or not, there's a question that everybody needs to answer. And the question is, do you invest in Bitcoin? It's not, have you sold it? It's not, it's, did you buy it? Do you have it? And, that kind of tells me that the government is trying to figure out exactly how big a market that is, because, I'm sure blockchain scares the hell out of them because they can't, it's virtually untrackable. I mean, they really have to work to track it. And, whenever the government can't track something, that's problematic for them.
Mm-hmm. Well, I think that pretty much covers all of mine. Did anybody else have any? And can you put your information back up there, Jack, yep, so we know how to get in touch with you?
Yeah.
Sounds like we need a conversation. I have, lots of different things that I have questions about, things I want to do. So
well, it is, I'll say this, that we are a little different in that because of we have a tax background, we are probably willing to engage in those sorts of tax conversations more than you're going to get in other places. I also have many times, for instance, with clients, I'm on the phone or somebody else in the office is on the phone with maybe your CPA, and we're trying to solve a problem or a complex set of investments for you, and giving you the best information that we can, so we can provide the the IRA side of things. Your tax guy can deal with those things, and a lot of that is better done in collaboration as opposed to trying to get it over the internet or something. So don't hesitate to email me directly, Jack at Mid-Atlantic IRA. Just put Samson in the message line so that I know that we've met, and we'll get to your questions. Phone numbers there. We have a bunch of webinars specifically on real estate. There's, I think, 3 or 4 of them. We hold meetups in various areas. If you have a group you want us to talk to, we're more than happy to do that. We're going to have a boot camp in the spring. It's in the middle of the May. I can't remember what the date is right off the top of my head. I think it's the 15th. It's a half day, and it's on these sorts of things. If I think the cost is $295. If you come from Samson, we'll give you a 50% discount. Just put that in the byline there, and we'll support you however we can. So,
That's fantastic. I'll send you an email so that we can get maybe a flyer or something that I can distribute to the company
oh, thank
and
you.
get a little bit
Absolutely.
more about that, because I think, I mean, it's when I was first introduced to this the number of years ago, it was like, what? I can take my own money and invest. I don't have to go to a bank and ask them. I can build my own wealth through my own money. It was like, oh my God. So
Yeah.
it's exciting, I think. Do we have any last minute questions? Otherwise, we'll end the session. And again, I really appreciate your time.